Thank you for watching this video. Today we will be doing technical analysis on the S&P 500 for the week ending Friday, April 8th, 2022. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. My name is Rodney Constable. I have over 30 years of investing experience, including over 25 years of experience trading stocks and options. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the developer and president of Simple Market Signals at simplemarketsignals.com. The chart we're looking at is an hourly candlestick chart of the S&P 500 that goes back to December 20th of 2021. And the reason I wanted to use this chart, guys, is I wanted you to see literally every hour of trading that has happened so far for calendar year 2022. All right, so this is the chart we're going to be working off of. You can see it's a naked chart. I have no annotations. Let's open up the annotations tool and get to work here and see what we can what we can figure out, what we can find. All right, so the first thing we're going to do is we're going to look at using a horizontal line. All right, and let's kind of take a look at what has happened. Now we came up to around this 46.25 area, if you can see on the right hand side of the chart, and hopefully you're looking at this on a computer screen. If not, I would encourage you to do so. And we kind of peaked just above 46.25 here at the end of March. We've been pulling back since. All right, but I'm going to drop this line right around this 45.50 level, because what I know is we've had very little trading since really the second week and beginning of the third week in January. We've had very little trading above 45.50 on the S&P 500. You can see a few hours of trading here in February above 45.50, and then just a few hours of trading above 45.50 as we have tried to rally back. Now, you know, guys, this very quick ascent a couple of weeks ago really felt like a bear market rally to me. Now, when I say that it felt like a bear market rally to me, you know, technically we were not in a bear market. The lows so far of this downturn were hit on intraday on February 24th, right here where you can see my cursor circling, all right? And we were down just a little less than 15% from the all-time intraday high that we hit back on January 4th, all right? So from right here where my cursor is circling now to right here, that drawdown was 14.61%, all right? I've just got it memorized, all right? And, of course, we've, you know, come up quite a bit since then. But guys, this ascent angle, right? This was extremely steep, and now we've given back at least a portion of that, all right? And so I'm going to grab another horizontal line, and let's again do some more annotations. And when we drop that line in there, you can really see that the S&P 500 came down this week and just stopped right at that level, all right, during the course of the week, all right? So is it possible 44.50 will hold up and that'll be, you know, and we can go higher? It's possible, guys. I don't think it's very probable. A more probable area would be maybe the 43.50 level, because that has been a very, very important support and resistance level for, you know, about 9 months now, all right, 8-9 months. So it's possible 43.50 can hold up. But guys, you know, this is still a very, very dangerous market, all right? And what I want to do here is I want to show you what has happened during this last week, right? That it wasn't, you know, where the S&P 500 went and some other investments. So stay with me, okay? Because I want you to understand the backdrop that we're in here. The S&P 500, and I've got this set for 1 week, S&P 500 down 1.27% this week, all right? But look at this. You've got small caps, the IWM down 4.67%, mid caps down 3.37%, the triple Qs, the NASDAQ 100 was down 3.51%. All right, so the S&P 500 itself was not down that much this week compared to a lot of other investments. All right, now let's lift up the hood on the S&P 500, so to speak, and let's take a look at the sectors of the S&P 500. And guys, stay with me here. This is super important. All right, and also I want to point out that the wealthier you are, if you're a six-figure earner or a high five-figure earner, but if you're, but especially if you're a six-figure earner, you own a business, you have a 401k or a 403b at work where you have hundreds of thousands or even millions of dollars in your 401k or 403b, guys, the things I'm going to share with you, the information I'm going to tee up at the tail end of the video could be worth tens of thousands or hundreds of thousands of dollars or more to you over the course of your working life. So please watch the entire video, guys, and understand what I'm sharing with you, because for a lot of you, it could be worth a lot of money, okay? And if you're a newer investor, guys, I've been at this a long time. Please do not, if you're in your 20s or 30s, don't dismiss the information I'm sharing with you, okay? Because this stuff, it may not be the sexiest stuff out there, but it can be to you, if you'll pay attention, it can be some of the most important information that you will ever learn on investing. All right. So with that said, let's take a look at the sectors of the S&P 500 just for this last week. There's 11 major sectors in the S&P 500. I have ranked them already on a 1 week basis on the relative performance, okay? And we can see, look at what performed well this week. Healthcare, energy, consumer staples, and utilities were up, as well as real estate. But look at the stuff that was down, and look at technology, down 3.82% this week, guys. We're going in the wrong direction on the things that really have growth. Technology, consumer discretionary, and communication services are really three of the most important sectors, my way of thinking, inside of the S&P 500, and these sectors, along with industrials, financials, materials, all down this week. All right, these are the things you want to see leading the market higher, not leading the market lower. The value, right, the conservative stuff were the things that were up. And guys, it's not just equities that are down. Look at this. These are high-quality bond ETFs, right? We've got the short duration, the 3 to 7 year, the midterm, the IEF, which is the 7 to 10 year, right? And then we've got the 20-year plus ETF. Look, this is just this week, guys. Down the IEF, the 7 to 10 year, down 2.34% this week, guys, okay? And these are the things, if you're an asset allocator, you're used to using a 60-40, 70-30 portfolio, these are the things you want to rely on to help buoy, right, and support your equities. Guys, it's not working. And with the Fed now on target to sell like $1 trillion of assets off of their balance sheet, and they're not buying bonds, they're not stimulating the market like they have in the past, this probably is going to continue to get worse. All right, and this is just on a 1 week basis. Please pay attention to this, guys, because again, you've got equities that were down. This is just this 1 week. Let's back this up. If we go to year to date, look at this. Virtually everything except value. This is a value ETF. It's up 59 basis points, 0.59% year to date. But look at this. You've got triple Qs down over 12%. You've got small caps down almost 11%. You've got FXI, which is China large cap, down almost 12%. Okay? Everything is down. And if we go back to these high quality bonds, look at this, guys. High quality bonds. You've got the short duration, the shortest of these, IEI, down 6.31%. You've got the 7 to 10 year down 9.16. You've got the TLT, the longer duration, down 15.21%. Guys, these are high quality bonds. And it doesn't matter what the yield is anymore, right? If you're down 9, 10, 15% on your high quality bonds, you can't make enough on the yield to make up for the damage that's being done to the capital side. All right, you're losing money in bonds, you're losing money in equities. All right, so investing in the traditional manner is not working, and it probably, and I'm talking about asset allocation, 60-40, 70-30 type portfolio, guys, it's not going to work right now, and it's probably not going to work for at least a few more years. All right, you're going to have to take a different approach to investing. And I can help you with that, but you need to pay attention to the balance of this video. You need to come at this with an open mind, and you need to understand what I do and how I help people. All right. And guys, what I'm going to share with you is not going to, We're talking something that's super, super affordable for almost anybody out there. And for most of you, you're already spending the money, right? You're giving it away to the stock market. You're giving it away to the bond market. Okay. Nothing is working. Let's take a look at the sectors year to date, because I want you to understand this as well. And I want you to understand, before we move on, just how lopsided everything is right now. The energy sector is up 44.67% year to date. Utilities up 823. Consumer staples up 255. Do you really think these are the sectors of the S&P 500, the growth sectors, the things that we want to be performing? And the only other sector year to date, right? Here we are, getting towards the middle of April already, into the first week in April, and we've got 4 sectors that are positive. The last one is healthcare. Guys, these are all conservative, down market type things, right? The only, these are the things that work in down markets, and that's fine if this is what you own. But look at this: technology down over 12% year to date. Communication services down over 12%. Consumer discretionary down over 12%. These are the things we want to be working, not taking the market lower. Okay, so I am not trying to be bearish or negative. That's not the point. I'm factual. I'm realistic. Okay, so guys, with that said, just remember, you're losing money in bonds. You're losing money, in most all the sectors of the S&P 500. You're losing money in large caps, small caps, international, domestic. You might make a little bit of money in value, but that's going to be about it. All right. So with that said, if on a go-forward basis you want an advantage, if you want to put the odds in your favor, as has been said numerous times for numerous reasons, success is about being in the right place at the right time. If you want to put the odds of being successful on your side, if you want to have an advantage when it comes to investing in the stock market, if you want to know when it's safest to be pedal to the metal in equities and when it's most dangerous to have equity exposure, please pay close attention to the balance of this video. And especially if you have, $100,000 or more in your 401k or whatever, right? The more money you have, the more this is going to be worth to you. Okay. And spend the next, few minutes watching the balance of this video, and you're going to understand exactly what I'm talking about. Now let's go back and take a look at how simple market signals could have helped you in the bear market that started in 2000, that ended in 03. And then next we'll take a look at the bear market that started in 2007, that ended in 09. So in 2000, you can see that the risk signal, the market mode signal, would have turned red right here at approximately 1450 on the S&P 500. In this risk signal, the market mode signal would have been red through the majority of this downturn, and then turned green right here just under 900 on the S&P 500. So think about that. Any of you that lived through this, any of you that were invested in the stock market during this period of time, as I was, right? I was working for Oppenheimer Funds, the mutual fund company, during this time. But you can see here, guys, this huge drawdown, right? This hurts, and it lasted for several years, and it just felt like every time we were starting to pull out of this, something would happen that would send us lower. All right. And these types of downturns, these prolonged downturns that last years, they are brutal. But think about how much knowledge you'll have when the risk signal is red whenever we get to the next bear market, right? Whether it lasts a few months or a few years, when you know that risk signal is red, you know what to expect, right? Losses are much more likely than gains, and so you can take the proper measures to protect yourself, and you'll have realistic expectations as to what is probably going to happen. But then when that risk signal turns green, you know that the likelihood of you making money has substantially increased. Okay. Now let's take a look at the bear market from 07 that ended in 09. And you can see here that the risk signal would have turned red right here, right around 1500 on the S&P 500. And you can see that the risk signal would have been red for the majority of the downturn. We did have one short green signal right here that lasted 1 week and then the market rolled back over. And so maybe you would have had a small loss here, okay? But that's just the way any type of protective system works, guys. But think about this. Again, you could have got out, or went to cash or done whatever you wanted to do right around 1500 to protect your portfolio, and you would have had a green signal that would have came out around 875 on the S&P 500 right here in 2009. So 2 of these types of downturns in the course of a decade, and simple market signals could have helped you really protect yourself and really understand what was going on in the market and set realistic expectations for you in both cases. And when the risk signal turns green, as it did right here, you will know that the likelihood of you making money in equities has substantially increased. Why is simple market signals so important? Because market risk is the single biggest risk most investors face. And market risk is non-diversifiable risk. Market risk cannot be diversified away. And future investing success will require getting in sync and staying in sync with the stock market by using stock market-driven data. Simple market signals is built around a multi-factor stock market-based model. I'm going to repeat that. Simple market signals is built around, based on, a multi-factor stock market-based model. Simple market signals identifies the current level of market risk, giving you the opportunity to stay in sync with the stock market. Now let me share with you what subscribers are saying about simple market signals. First, we are going to hear from KT from Michigan. I have been trading for many years. I did not realize that I have been trading in a completely blind fashion. SMS has given me the direction, literally, I've been desperately needing. This service allows you to clearly see what the market is doing. If you are remotely serious about trading or investing, you must try this service. Again, that's from KT from Michigan. KT, thank you. I appreciate that feedback. Next, we're going to hear from SC from Florida. And SC writes, I manage my own money and I am not a professional, which could lead to a disastrous outcome as it has for many. Simple market signals is the equivalent of having a personal money manager that keeps you invested when it counts and alerts you to the potential dangers ahead. Now, I want to point out here, guys, I used to be a money manager. I sold my practice in 2016. So these are the exact words that SC from Florida wrote to me. So I just printed it as is. But I want you to understand, I cannot give advice. But this is the feedback that SC from Florida gave me, so I appreciate this. So again, SC writes that simple market signals helps you stay invested when it counts and alerts you to the potential dangers ahead. The service is extremely affordable and takes the uncertainty and fear out of being in control of your own investments. I have done very well using this system and consider myself lucky that Rodney's YouTube channel came into view one day. I highly recommend this to anyone who desires an easy system to produce positive returns in the markets. Again, that's from SC from Florida, sent from his iPad. And guys, I want to point out the reason I'm using just the first and last initials is for the security of my subscribers, okay? I have hedge fund managers, very well-off, multi-millionaire clients. I have, people that are high up in various areas of the government. I have people from all walks of life. So just out of respect and security for my clients, this is the way that I'm presenting the information, just with their first and last initials as well as their state. Next, we're going to hear from FS from Massachusetts. Rodney is spot on in his reading of the markets. I was looking for a heads up to help me choose which side to use for vertical spreads. Again, that's from FS from Mass, and thank you so much, FS. I appreciate that. Next, we're going to hear from JV from New York. Now, I posed a few questions to my subscribers a few weeks ago, and this is the feedback exactly that JV from New York gave me with respect to the questions. So I produced it just as he wrote it. So the first question, what do you like best about simple market signals? What JV said was, One of the things I like best about simple market signals is that I have an easy-to-use tool at my disposal. I use the green, yellow, and red signals along with the general trend to help me determine how much equity risk exposure I want my investments to have in the market at any one time. I will either increase or decrease my equity exposure based on those metrics. The next question, what is important about simple market signals to you? JV writes, I am a conservative investor. My main goal is to preserve as much capital as possible during market downturns, yellow and red signals, and to optimize my returns during green light conditions. The next question, how has simple market signals helped you? JV writes, SMS helps me to determine whether to stay the course, increase equity exposure, or take defensive positions. For example, I will add additional funds to my equity investments during green conditions and move money to cash during red conditions. And the last question, how have you benefited from simple market signals? JV writes, one of the benefits of SMS is that it has reduced the stress from always looking at and analyzing market conditions and worrying about it on a daily basis. And again, this is from JV from New York. JV, thank you so much for the feedback. I really appreciate that. There's two major components to the simple market signals proprietary model. There's the risk mode, the market risk level signal, and then there's the general trend indicator. Let's start off with the simple market signals risk signals. The simple market signals risk signals, the market mode signals, are simply green, yellow, or red. When the signal is green, this is when you're going to have your easiest, lowest risk profits. And this is when the market is generally in an upward market mode. When the signal is yellow, this is when we have a soft market and the market is generally sideways to slightly up or down in a yellow signal environment. And what you're going to find is when the market mode or risk signal, right, you can refer to it either way, but when the market mode signal is red, the worst losses, including bear markets, are going to happen in a red signal environment. So when the signal is red, the market is generally in a downward mode. Next, let's take a look at the general trend indicator. The general trend indicator measures the trend of the stock market based on our proprietary formula. The signal is either positive or negative. When it's positive, we're in an upward general stock market trend. When the signal is negative, we're in a downward general stock market trend. Now let's take a quick look at a few market mode risk signal charts for the last few years. We're going to start off with 2018, and you can see here what I was talking about, that most of your upward progress in the stock market will be made in a green risk signal environment. The yellow signal is kind of a sideways to slightly up or down signal, as you see here. And then the red signal, right, this is just 2018. We'll look at a few more here in a second, but you can see the red signal here that we had in the latter part of 2018. And then moving on into 2019, we came into the year with a red signal, and then it went green, and you can see the progress that we make here. Yellow, correction, green, yellow, green. So you can see that most of the yellow signals go back into a green. The yellow is kind of a short pullback in a lot of cases, but as we saw here in 2018 and what you'll see also in 2020 is the yellow signal can be that transition signal between a green signal and then a red signal, as we see here with the COVID sell-off in February, March of 2020. And again, as we see here, right, most of the upward progress in the stock market is going to be made in a green signal environment. So think about this, guys. As long as the signal is green, you can see there's just not a lot to worry about, right? And even most of these yellow signals, this is when we get that pullback, but it gives you confidence in knowing what the market is doing. Now let's take a look at a few charts for the general trend indicator. And just like with the risk signal, we're going to start off with 2018. You can see we came into the year with a positive signal, had kind of a chop here where we went back and forth between positive and negative for a little while in February, March. We had an outright negative signal and then went back into a positive. But you can see here, right, this sell-off that we had in Q4 of 2018, we've already looked at the fact that that risk signal went red, and you can see here that we would have had a negative general trend indicator signal as well. And then you can see here when the signal is positive, this is when you get the most upward progress in the stock market. And this takes us into 2020. Of course, we had the negative signal right here during the COVID sell-off in February, March of 2020. And this takes us again to the end of August, beginning of September of 2021. And you can see here positive, very short negative signal, and then a nice long positive signal. And again, just like with the risk signal, I'm stopping the data at the end of August. And if you want the most current information, please become a subscriber. The signals are delivered to subscribers in our weekly video newsletter. In the weekly video newsletter, you will get weekly updates on our proprietary market mode signal. That's our risk level signal. And of course, you'll also get the updated chart for that signal each week. You will also receive the proprietary market mode risk level signal on all 11 major sectors of the S&P 500. You will also receive a weekly update on our proprietary general trend indicator signal, and of course the updated chart for that. You will also receive market analysis on over a dozen charts every week covering all major areas of the stock market, including several international charts. So I'm going to cover small, mid, large. We're going to cover both a growth and a value ETF. I mean, guys, this is going to help you understand what's going on across the board. Of course, several charts every week on the S&P 500. We'll cover the Dow. We'll cover the triple Qs. So we're going to cover pretty much everything in there, okay? And so this is going to give you a really solid base every week as to what's going on in the stock market over and above our proprietary information that we're sharing with you. And then depending on what's going on, there will be occasional bonus material, not necessarily every week, but occasional bonus material, and this will be anything additional. From week to week, these things will vary, but these will be important and timely things that I feel that you guys need to know at the time that the information is delivered. Okay, so that'll be the occasional bonus material. To be fair to myself, I should be charging $97 per month or more for this information. However, you're going to get everything for just $19.99 per month. That's less than 67 cents per day. And to become a member of the channel and get access to the Simple Market Signals information, you will need to go to the Rodney E. Constable Stock Market channel. So depending on how you found the video, you may or may not be there, but you need to make sure that you go to the Rodney E. Constable Stock Market channel, and then you're going to click on this join button. Now, if you're not signed into YouTube, you will need to sign into YouTube. All right, and then once you're signed in, then you'll see this box pop up, right? Get access to exclusive perks when you become a member. So you click on the join button and you will see the information here, what you're going to get with your subscription, of course, your membership. And then you click on the join button and you want to add your credit card information. So as you can see here, you can pay with either a credit or debit card, enter your card number, of course, the month and year of expiration, security code, cardholder name, and your billing zip code. So I'm going to fill all of this information in, and I will be right back. So once you hit that buy button, which is in the lower right-hand corner of that box, that previous box, you will then get this pop-up. Welcome. It's great to have you as a member. So then you can click on the See Perks. So once you fill all that out and your membership is established, then you will have access to the membership area where you will be able to see the perks, right? And then you go over to the community tab, and this is where you will have access to the various videos, and you just click on those and it'll pull those up. Okay, so I'm going to back up here, and so this is where all the training videos will be, as well as the weekly updates to the Simple Market Signals that will be under the community tab. And that's all it takes to become a member. It's quite simple. And you will have easy, convenient access to this information. Everything is on YouTube in the members area of the channel, and everything is in video format. There's no emails to mess with and no websites to log into other than, of course, YouTube. So just to review the membership details, the video membership to Simple Market Signals through YouTube is $19.99 per month. That's less than 67 cents per day, and it's billed monthly on your credit card, or you can pay with PayPal. There are no contracts. You can cancel anytime, and if you do cancel, your membership will remain active for the balance of that current month, right, for that prepaid period, but you won't be billed for the next month. All memberships are controlled by YouTube, so if you ever have any question about anything, just Google it and the answers should be out there. Some of my clients tell me they make tens of thousands of dollars per year from the information they learned from being a client of Simple Market Signals. It's not often you have the opportunity to invest a few $100s per year in yourself and potentially pull out thousands or tens of thousands of dollars per year from that tiny investment. This year, give yourself the gift of financial knowledge that can bring you big rewards over your lifetime. Now let's recap what you will get as a member. As a member, you will receive the weekly video newsletter, which includes the weekly update on the proprietary market mode, also known as risk signal, on the overall U.S. stock market. You will also receive the weekly update on the proprietary market mode or risk signals on all 11 major sectors of the S&P 500. You will also receive the weekly update on the proprietary positive negative signal for the general trend indicator. You will also receive weekly market analysis on the overall market, and there's generally 12 plus and sometimes more than 20, right, depending on what the information I need to disseminate, but there's generally at least 12 plus charts every weekend covering all major areas, right? Small, medium, large, growth value, all of that, including several international charts. But all of this is over and above the proprietary risk signal. So the weekly market analysis alone, guys, is worth far more than the $19.99 a month that we're talking about here, okay? Plus, you will receive occasional bonus charts as deemed necessary and appropriate for whatever's going on in the markets, all right? So that's bonus material that I do throw in from time to time, and that can be extremely valuable to you. Plus, you will receive special midweek updates when warranted. So again, if there's something going on in the markets, if there's a signal change in the middle of the week, we will put out a midweek update video so that you can stay current on the information. We'll get that out as fast as necessary, okay? And you'll also receive access to the growing video library of best practice educational videos that are part of your membership, and that will continue to grow over time, all right? Again, you're going to get all of this for just $19.99 per month. That's less than 67 cents per day. So join now to start benefiting immediately from this valuable and potentially life-changing information.